Welcome everyone today, and for our clients and anyone who has logged in from the general public. I'd like to thank everyone for putting a bit of time aside today to listen to our presentation. And we will be recording this session today, so if you are listening on our YouTube channel, we hope that you get some value out of today's discussions. I'm Frances Easton, a Director and Financial Advisor at Alman Partners, and I have one of my partners today as well.
And that is me, Steve Lowry, also a Director and Financial Advisor with Alman Partners True Wealth.
Fantastic. So today I'd like to just let everyone know that we've got a few topics to talk about today, and Steve, you might want to be able to introduce them to everyone.
Yeah, well, there's a few things I want to go through. First of all, just a bit of a market update, Frances. We really want to have a look at what markets did in the first quarter of this year, considering what we've been through with as COVID-19 became, a real topic, and economies started to, started to show signs of stress. And then we're going to look at what's happened in the last quarter, and then we're going to talk about a couple of subjects dear to your heart, Frances.
Yeah, look, there are definitely discussions I'm having with our clients at the moment. Is this really the new normal when it comes to markets? So I'm sure everyone's heard that in the media, that, this is different this time. So we'll talk a bit about that, and also how we make a deliberate plan in regards to what we choose in asset allocation, what risks we take on as our investments.
Right, so being deliberate of what you do in your strategy.
Yep, that's exactly right. So they're things that certainly we'll explore a little bit further today.
Great. And then I'm getting a question all the time, Frances, on the golf course normally. I don't know why. But people keep asking me, if the economy is going through such stress and most of the world's going into recession, how is the share market rising? Aren't they correlated? And does that mean that they've decoupled? So I think a lot of people are wondering how that works. So I think in layman's terms, I'm going to explain that for everyone later on. So buckle in.
Yep, fantastic. Well, no doubt that's a good question. I look forward to hearing that one, and keeping it in simple terms, Steve. So today I'd just like to firstly mention before we get started that no doubt this information is general in nature, and if you are seeking investment advice, or if you're actually going to be making some investment choices, I certainly encourage you to seek some advice from your advisor. For people today who have logged in to our presentation who don't have an advisor, certainly reach out to us. You're most welcome to come and have a chat and a coffee and explore certainly your circumstances financially.
Great. And did we say we're recording the session? We
are recording, Steve. So for anyone out there who wants to listen to our voices again, Steve, or anyone who you'd like to share this with, certainly it'll be on our YouTube channel after today.
Right, so just go into YouTube and type in Alman Partners.
I believe so.
There's a lot of good resources on there, so if you haven't been there, please make sure that you go in. All right, well, let's have a look at the first quarter of this year, and I guess I want to premise the discussion today that, look, we acknowledge that we're going through an extraordinary time in the world, and many people are suffering, and so we want to acknowledge that. And we know that we've got a fair bit of pain ahead of us. But today I just want to really talk about markets, investments, and what's happening. So here is the first 3 months of this year. As COVID-19 started sweeping the world, markets started to price that uncertainty. What is this thing? What does it mean? How long will it go for? How many businesses will go broke? Will we go into a recession, depression? So in the first quarter, there's 3 benchmarks we're looking at here. The top one is the Australian share market, the All Ordinaries Index, top 500 shares. The second one is the S&P 500 Index, which is the top 500 US shares. And you can see the corresponding negative returns over that quarter. And then the last one is the MSCI World Index. You don't hear that so much on the news, do you, Frances? Like
No, it's probably more an academic benchmark, I suppose, but it really represents the whole of the world market, and no doubt 50% of that's made up of America, so the USA. So
every developed market in the world, excluding Australia, and America makes up 50% of that.
Yeah, which is quite substantial, isn't it?
Yeah, it is. Yeah. So look at those falls. Australia 23.9, America 19.6. The world economy only 9%. That was interesting. So of course, there's a lot of fear around at that time, and we ran some webinars for our clients, and good to see many of those clients here again today. So
definitely some familiar faces.
Well done. We did 3 sessions in March just to help people understand what was happening, to stay seated, not to make emotional decisions. And we looked at volatility across decades to see how long it might take for markets to rebound. And we spoke about how quickly that can happen, and you can't time it. So, you know, most investors at the moment are probably feeling a little bit of whiplash. You know, this is the second quarter of this year, and markets have rebounded significantly. Frances, you were saying before about how quickly that's happened, and
yeah, it's just a really interesting data, I think, Steve, when we look back in history over the last, you know, they say over the last 30 years that the first quarter where we saw the COVID-19 effect, particularly in March, it was our, you know, out of the top 10 worst quarterly performances over the last 30 years.
wow.
And but on the flip side, we look at April to the end of June, it was actually in the top 10 best quarterly performances. Yeah. So, you know, and I certainly reflect. I know I've got a few State of Origin fans on the attendee list today.
Oh, stop it, Frances. You know I'm a New South Wales supporter. I've got a lot of pain there.
Look, I have to say it, but you know, I certainly reflect, and I think we're missing our State of Origin this year, no doubt. But you know, if I reflect on that, there's been many a times. I must admit, I'm certainly don't usually watch the full match. You know, I'm usually putting the kids to bed at some point in time. But you know, by the time I get back, the Queenslanders are just blitzing the New South Walesers. You know, so
all right. I
should have sat in my seat. I should have watched that good performance, no doubt. But it's very reflective. Same with the markets, as you say, sitting in your seat.
Yeah, that's a great analogy. We won't talk about that again, will we?
I can't promise that.
So looking at the whiplash of the markets, it's interesting that number one, the American market had its largest one-day rise in history in that time. And who would have picked that in March?
I don't think anyone would have. You know, there was doom and gloom, and it was a crisis, wasn't it? You know, and it's still today.
Absolutely, absolutely. Yeah. And then you look at if America, that S&P 500 index makes up 50% of global wealth, if you like, of markets, and the MSCI World Index only rose by 5.9%. I think that would indicate that a lot of European countries are doing it tough.
That's right, exactly. And no doubt we're feeling for, you know, the pressures they're under at the moment, personally, with COVID-19. But you know, I suppose it's really a question of, Steve, we are, you know, being, you know, we're speaking to people, we're hearing in the media, this, you know, this is the new normal. I certainly personally hope that, you know, I can be hugging my clients and shaking their hands again pretty shortly. And certainly we understand that it is different when it comes to being a pandemic.
Well, let's look at the last 10 years, and then get onto that subject, which you're going to cover in a minute.
Yep, exactly.
Here we go. So, put it in perspective, the last decade returns prior to where we are now have been incredibly strong. You know, the Australian market didn't have its best decade, 7.8%, the American market 13.5%, and the world index 12.3%. The first thing I'd say there, Frances, is in our webinars in March, we looked at the Australian share market per decade for 115 years, I think it was. So here we are now with data for another decade, it's 125 years, and this is only the second time in history over that 125 years that we've had a decade return under double digits. But you know, when you look at it, this is where diversification comes in, because our clients in their equity portfolios have exposure to global equities as well as Australian equities, and those returns are a lot better than term deposits.
Yeah, certainly, and that's a number of conversations people are bringing up. It's certainly not worth keeping your money in the bank at the moment, unless, and you don't want to be putting under the bed, obviously, either on the pillow.
So is this a new normal, Frances? That's what people are saying.
It's really, I think, for us to go back in history and reflect on, you know, we've had many crises before, and like I mentioned before, it is different, no doubt, because we're in a pandemic. But as a whole, when we look at portfolios and investment portfolios, this particular one that we have a look at is got about 60% in growth assets and 40% in bond markets.
So this is like a retirement portfolio, so for a retiree,
Yep.
and what it's done 1, 3, 5 years after these significant events, right?
Exactly right. You know, it's something that we would look at and deliberately consider for maybe someone who is looking at before pre-retirement or through retirement, depending on their risk aversity and what they desire and what their goals are. So I think it's quite common people hear the terminology of a balanced portfolio. So if you have an industry super fund out there, that is quite a common terminology.
Right.
Yeah. So I mean, there are a couple of things here. Look, we've got, you know, crises aren't predictable. I don't know if anyone's been able to predict any of these crises in the past. I certainly would never have predicted a pandemic in my lifetime. And I think a couple of things we can take out of this information here on this accumulated 5-year returns. You know, a number of our clients went through the global financial crisis back in 2008 and the lowest period in 2009. About February 2009, and it shows us on this graph, it took around about 5 years for markets to really recover in a positive state. So just like I used the analogy of the state of origin sitting in your seat, time is certainly of the essence to continue to sit in your seat there.
It was challenging, wasn't it?
Oh.
You know, looking back as advisors, you know, 2, 3 years down the track, you're still only 1% growth from the bottom.
Yep.
Incredibly challenging, and just goes to show the reward of patience when you look at that 5-year.
That's right. I think we used the analogy, or the terminology at the time, investment fatigue, really, Steve. You know, people were feeling fatigued at the time. Is this going to really work? But it shows you, you know, for many of those crises, even 1 year on, we're in positive territory again.
Surely it's different this time.
Well, you know, what I can tell you is I certainly can't predict what's going to happen in the future, but I do know one thing, that it is normal. You know, markets will continue to react. We know that they go up and down. But another thing I do know is if you have a pathway, if we're prepared for crises like this in the way of investing, we certainly can feel a lot more comfortable pre and post those crises.
Sure.
And for a lot of our long-term clients, I think if I draw this line through this particular illustration, this illustration is from Carl Richardson from Behaviour Gap. He indicated, and certainly illustrates quite well, that, you know, you can have a trajectory up with that planned process of how you invest. And it's all about, you know, long-term returns.
So no volatility is not normal, right?
No, yeah, I've never seen a market look like that. You know, that's not normal. And certainly for us and for many of our clients, they would know that experience. That's not a surprise.
Well, that's the risk and return story, isn't it? You know, risk and return are related, volatility, and as you go through those ups and downs, you get rewarded for taking on that additional risk.
Yeah, Stephen, I think if anyone out there who hasn't had an investment experience in markets, bond or share markets, it's really about a couple of things that you need to be aware of before you go in and have that expectation is we know that markets are uncertain.
Yeah.
You know, if you have that expectation before you go investing, but you also want to explore the probabilities and the possibilities and the outcomes that come with that and what type of risk you want to take on board.
Absolutely. Yeah. And, you know, when we did this slide, I said to you that, you know, if someone invested 30 years ago and then they didn't look at their portfolio for that whole time, came back 30 years later, that line going up is their experience, right?
Yeah, that's right.
They started here, they got there, and because they didn't look at it all the time, they didn't experience those ups and downs and the emotions of it all. But that's pretty well our journey, isn't it, long term?
Yeah, exactly. And I certainly can remember conversations with some clients saying, look, we're not watching the news in the global financial crisis because we are in a bit of a local bubble here when it comes to, you know, what we've seen with COVID. A lot of our mining community are essential workers, so things are ticking over and continuing. But we do acknowledge, no doubt, you know, the world is hurting at the moment and a lot of people have lost their jobs.
Yeah, absolutely. Let's not forget that. Well, let's talk about then, you know, this doesn't happen by chance, having a good investment experience, and you spoke about being deliberate in your investment decisions. Tell us a bit more about that.
Yeah, look, when I talk about deliberate, it's about, you know, planning, as simple as that. I can reflect on a conversation I had with a client a couple of weeks ago. Someone who came to us 6 months ago with some money, they wanted to invest. They had not so good experiences with markets in the past. And I suppose behaviourally had pulled out of share markets when they were down in the past. So, and certainly not an appetite for too much risk. So I think when we talk about these things and explore how people feel and certainly how they've dealt with things in the past and re-educate how markets work, I think it's really important that we deliberately, for this particular client, actually gave them exposure of about only 30% to growth assets, so shares and property.
Right, so they weren't getting a return on their capital in the bank in term deposits, which many people are feeling at the moment.
Yep.
They wanted to get a better return. The only way to do that is to introduce some growth assets.
Exactly right. And they acknowledged, no doubt, that they were just pre-retirees. They're about to prepare for their retirement. They acknowledged that whilst they retire, they won't want to retire their money, you know, so they know inflation's their biggest enemy when it comes to, you know, putting your money in the bank. And I think we can all, you know, reflect on that when we think about how much things have cost in the past and continue to cost. So we're looking at this sort of thing. I think it's the key. You can see down the right-hand side, you know, someone who has 100% in growth assets, and that might be our accumulator, it might be someone who's got 30, 40 years in superannuation, it might be even 20 years, but it's certainly long-term they're considering. But on that flip side too, they're taking some benefits. I know they've received a negative 14% return over the last six months.
So these are our Alman Partners model portfolios.
Yes.
Over the last 6 months, and the top number is how much growth assets or shares are in the portfolio. So
exactly,
your client invested in January, and so their portfolio is down 4%. But because you're deliberate with their risk tolerance, they can sleep at night with that experience.
They certainly can, and it was a conversation we had around why we chose that and the deliberate nature of that, because imagine if we chose, you know, a portfolio of 100% growth assets or even 30% growth assets. They really said that they felt very uncomfortable if they saw their portfolio, you know, fall by a further 10% or more. So I think that's really something that you need to be considerate of, like I've mentioned before, when you're planning, know what your possible outcomes are before you invest that money. So really from that perspective, I suppose we also spoke about it on the flip side. You know, if we're looking at 10 years and expand that over a 10-year period in that basis. So sorry about that. We're just going to have a look at some technical issues there. So when we flip on the actual graph, and if I could just get you to turn over the page, Steve, we also spoke about returns in regards to what they compromise with when they take on a level of less volatility.
Right, so the client who decided they didn't want to take on so much risk, the comparison of that is long-term, they won't get as high a return, but they're happy with that.
Yeah, exactly. They're happy with that. They're certainly, it's a sleep at night policy for them, as I call it, and they're very happy to get above cash rate returns, but also not take on the level of risk that someone like a 100% growth portfolio would take on.
Yeah. So, you know, this is over that 10-year period. So the 100% shares has corresponded to a bit over 7% return, as we said before. And our retiree clients, 50-50, you know, just a bit under 6%. So a lot better than term deposits.
Oh, certainly. And like I say, inflation's the killer when it comes to putting your money in the bank. And you know, the conversations we had through after the GFC, I think were ideally prospective clients coming into us saying, look, we just are eating away at our capital. You know, as retirees, if we keep that in the bank, we really do need to seek a higher return, but we don't want to take too much risk on board. And certainly we can empathise with that.
Well, 50% of your capital in defensive assets in buckets of cash and fixed interest. If you've got $1 million, you've got 500,000 to draw on and get you through those hard times. So that's certainly very deliberate. Let's move on to that question about share markets not being linked to the economy. That sounds extraordinary. If companies, I mean, we've just seen our income distributions for our portfolios reduce significantly while companies hold their profits and their income, and they're not distributing as much dividends, which if you're a retiree and you're relying solely on those dividends, you know, you've got a double whammy now, term deposits low and low dividends. So if companies' profits are going down, companies are going broke, we're in a recession, how on earth does the share market grow?
It's a really interesting question, isn't it? And there's certainly been a challenging time for many out there. And Steve, I think this is a great illustration of what really makes up part of our market when it comes to businesses. So I'll get you to go through it with everyone.
Yeah, look, the first thing I'd say is that what we experience personally when markets are down is very localized and very personal. And so we tend to see the things that are around us, household names. So if you look at retail, travel, airlines, all of those sort of sectors, we see them and we live with them. And so it's very localized to us. And so when you're looking at that, you've got to say, well, if they're doing so poorly and businesses are closing down and putting staff off, the share market must be falling. Now, this graph here is the top 500 shares in America. And what we've done is we've broken that down into segments. So information technology, 27.4% of pretty well the total American share market wealth. Healthcare, 14.5%, and communication services, 11%. There's nearly 50% of the share market's wealth in 3 major sectors. And guess what? They're doing really well.
Yep, that's right. Well, what are we going to be watching when we're in lockdown and,
Exactly.
self-isolation, isn't it?
Exactly. Yep. So, and the other thing is, where do they derive their wealth from? So if I'm an American, I'm sitting down, I'm looking at these airlines going broke and all that stuff. What I'm missing is that nearly 50% of our share market derives its wealth from overseas, from other markets. And so it's a very different experience.
Yes,
what we experience and what the market experiences. And, out of that top 500 shares, about 470 are down. Isn't that incredible? And yet the share market is growing, has rebounded 20%. And a lot of that is, there are certain sectors that do really well in certain times. And we're not saying chase them, because as soon as you do, you narrow in on your portfolio, lose your diversification, and of course things will change. But, Facebook, Apple, Amazon, Netflix, Google, they're all having a heyday at the moment.
Yep, definitely.
And that's why the American market's doing so well. In Australia, we've also got a very concentrated market. Financials, the big banks, and also the resources, make up over 40% of our whole market wealth.
Yep.
And I don't know about you, Frances, but look out to sea. There's still 50 coal ships sitting off our ports.
Yeah. So, well, we're certainly in a local bubble here, and things are bubbling away still. So and no different, like I mentioned before, from the global financial crisis. So whether that continues or not, it's that's who knows? That's questionable. Yeah.
But that's pretty well in a very straightforward explanation why share markets aren't coupled to the economy. They'll do very different things at different times. I'm not saying we haven't got a lot of challenges ahead of us. We certainly do. But I just read this morning that the S&P 500's had another quite strong rebound, and the commentary was saying it really seems that those who forward look into the economy are saying that they can see things, the GDP in America changing around next year as we start to get a cure for COVID-19. So
yeah,
whatever it'll be up and down. We know that.
Yeah, and I think that's interesting. We can read many things out in the media. We can talk to our neighbours. We can talk around the barbecue. But I think the key thing is if you have a plan in place, and like we mentioned, being deliberate about how you choose your asset allocation and how you invest. I think that's really key to ensuring that hopefully you can feel a little bit more comfortable pre and post any crisis, Steve. So, our desire is to be able to, as you can see up there on the screen, our mission's lead, educate and inspire others. And I think the real key here is for us to be able to get the message out there. It's all about planning.
Yeah.
As simple as that. And if we can really plan the process and these crises, we certainly can't predict them, as I mentioned, but it's really important for us, if you don't have a plan for these crises, maybe reach out and come and have a chat with us.
Yeah, great idea. All my partners, True Wealth, been in Mackay for 35 years. We've been doing this for a long time. Our clients tell us over and over how appreciative they are of the advice and the support and the coaching that we give them. If you're watching this on YouTube and you don't have an advisor or you'd like to talk to somebody else, reach out to us. Just jump on Google. You'll find us somewhere. And we'd be very happy to offer you a complimentary discovery meeting. And also for our clients, if you've got people you think are struggling in this challenging time financially and they're not sure what to do with their capital, always feel free to pick up the phone and give us a call, and we'll be very happy to help them. So I hope you've enjoyed today. Frances, thank you.
Yeah, thanks, Steve. Always good to partner up in these things. So thanks very much.
Absolutely. The comic duo, I'll let the state of origin slide. Thank you for everyone who's tuned in today, and we look forward to doing another market update when we've got something to talk about.
Thank you.